Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight we're going to be taking it back to the basics here, talking about the fundamentals of the mortgage. We'll wait just a minute here. That way we can give everybody a chance to jump on. We did put the chat up on the screen, so feel free to drop a comment there as you tune in the chat. You can drop questions you have as well in the chat as we go through here today. You can ask Jose some questions. We can get to them at the end. Hope everybody's been having a great week so far. Thank you everybody for dropping comments in there already. Appreciate everybody tuning in nice and early. All right. So it looks like live on all the different platforms, so we can go ahead and get it started. We'll take the chat off the screen for now, but keep dropping comments there and let us know if you have any questions. So welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans, and what we do every Tuesday and Wednesday at 7 p.m. Eastern is this loan officer training series, and do a different training for loan officers. Our sales manager, Jose Gonzalez, with 28 years of experience as a loan officer and a realtor, is going to take us through some of the fundamentals here today. So I will go ahead and turn it right over to you, Jose, so we can get into it.
Good evening, everybody. Thank you for joining us for tonight's great training. So with all this movement in the market, all this great news we've been having lately, interest rates looks like they've peaked there. Looks like they're turning a corner. We're seeing more applications come in, agency applications, because we've definitely had quite a few non-QM applications, and now we're getting more agency, full doc borrowers. So we're getting a lot more variety. So we've been doing a lot of back to basics type sessions, both in our Daily Rates Live morning podcast and in the training that we've been having for LOs, right? Last night we were talking about borrower income, right? Analyzing borrower income, and we did a good emphasis on self-employed borrowers, getting a lot of those full doc files now. So today we're going to be talking about the fundamentals of the mortgage process, right? Gaining insights into types and programs, questions to ask while completing the loan application, and the importance of processing and complete documentation, right? Now, you know that we at the Mortgage Calculator love to talk about adding value to the transaction, right? Being a loan consultant, there's a lot of competition out there right now, and definitely how we are going to excel in differentiating ourselves is by adding value to the transaction. A lot of ways we add value. Obviously, good rates add value. Great service adds value, and part of that great service is efficient, thorough, being a good consultant, finding the opportunity that somebody else didn't find. I mean, it's not the first time that I've heard the stories either from my own personal experience or another MLO, another of our team, where they've gotten the deal, where the story is, another MLO just dropped the ball, another company, they couldn't get it done. And here we are taking over, putting out the fires in some cases that this other person may have caused by their ineffective actions, and then proceeding to properly analyze the deal and take it to a happy closing. Because in the end, not only are we going to, obviously meet the objective of the borrowers, we're going to meet it in a positive manner that is going to allow us to request referrals from those borrowers, and we will receive referrals because they're going to be so happy. We're going to delight them with our service. It's going to be a win-win situation, but none of that is going to be possible if your loan does not get off on the correct trajectory in a positive manner so that the end result is, a valid pre-approval and a happy closing, right? Valid pre-approval, the loan goes through as planned, customer closes, mission accomplished, and then you get more business, and that results in a more sustainable career as well for the MLO, right? All of these things are all very important things to consider, whether you're a new MLO, newer MLO, or a seasoned veteran looking for ways to improve, because we always can improve, especially in these challenging times, right? There's a lot of activity out there. We just have to know how to uh, meet the needs of those borrowers. So, again, taking it back to the basics now, right? What is a mortgage, right? I see the term mortgage thrown around a lot. So if you're going to effectively be a good mortgage loan originator, you got to know what is a mortgage, right? A mortgage really is not the loan. It's not the loan. The note is the repayment agreement. A mortgage is a hypothecation agreement where this is what's key to our our home industry, especially in this country, where we have title insurance and where we have public records that are kept, in an organized manner where you can go online and check information. So we have a lot at our disposal. But a mortgage is a hypothecation agreement where the borrower offers the property as collateral but does not give up title, ownership rights, nor possession of the property. A mortgage has a bunch of clauses on it. All of those clauses are terms that the borrower needs to meet in order to stay, for the lender or lien holder not to foreclose on the lien because the borrower is defaulting on some term of the mortgage, right? And those terms isn't just repayment, of the loan, right? That's one of the terms that's in there. And for the mortgage, for the hypothecation agreement, the note establishes the terms of the loan and the repayment of the loan. So the mortgages and the note, two separate documents. The note is one of the documents that establishes one of the terms, that the borrower has to meet. Some of the other terms, for example, on a mortgage are some of the clauses, for example, due on sale clause. That's one that you should all be aware of. That's if um, ownership changes in the property. And I'm not, and it can even be changed into an LLC, by the way, depending on the loan servicer and lien holder. But any change in ownership, like you see people a lot of times doing quick claim deeds left and right, stuff like that. They got a loan on the property. Oh, sure, just take over my loan, blah, 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 blah. Well, unless that loan is assumable, if the note holder finds out that that occurred, you violated one of the terms, the due on sale clause, and now they're going to tell you, hey, we are accelerating your loan and you got 45 days paid off, or else we're going to foreclose. So that's one of the terms of the agreement, whereby the lender can seize the asset if the terms of the agreement are not met. So now you all understand, how we deal in, mortgages, right? Who are the key players, right? Real important for you to know, because you need to know who to address your attention to, or what is each player's role in the process. Obviously, we have the borrowers, we have the lenders, right? The borrowers are the ones that need the service. The lenders, or the investors, if it's us and we're the lender, right? But the lenders lend the money, so we in this case are the lenders, the company. Um, Loan originators, we are the upfront soldiers in the process. The ones that are in the battlefield dealing with the customers and the loan applications and the whole process, right? We have the loan processors, which assist us in the loan application being processed, from application to disclosure to submission to condition resubmittal to closing, right? Those are our milestones. We have the realtors; those are our partners. They refer us business, um, purchase business. We love that. We pre-approve They're borrowers, they're buyers. So we provide a service. It's a symbiotic relationship there between realtors and loan originators. We have the appraisers, right? They are our property evaluators. They're a very important part of this puzzle. In the lenders, we also have underwriters for the lenders that are delegated. They review the documents and the risk analysis, assess the risk for the loan. Remember the other day when we were talking about interest rates, we're talking about risk. They assess the risk for the loan, approve or not approve. Title company, they do the title work, the analysis of the deed and liens and loans, and they close the deal, they pay off existing liens. I mean, without title insurance that we have in this country, our real estate business would not operate as effectively, as efficiently, and as profitably as it does. There's very little um, fraud in the type of fraud you'd find in other countries that don't have an effective public records. Now, obviously, there's title fraud here. You know, somebody gets in fraudulently tries to convey your property into their name, and you know you hear that, and you have companies that supposedly protect you against that. But so title, and you know, very important. And don't forget our property inspectors, right? Critical components, especially when we're talking about some deals like manufactured homes and the structural foundation inspection that you need to be able to close on an FHA deal. So different things that you need to be aware of in the process to be able to effectively consult your buyers and make sure that your loan closes. Now, what are the stages of the mortgage process, right? Now, here's one that I consider very important. You're not going to find it a lot of times when people are discussing the stages of the mortgage process, but I consider marketing, a very important stage of the mortgage process, the initial stage of generating the new business. What's going to be your target? Purchase, refi, non-QM, agency, first-time home buyers. There's a lot that's going to be determined by who you target for your marketing, going to determine the type of business you're going to be generating. Obviously, we don't want to just hyper focus too much on just one group, because if that's putting all your eggs in one basket. We like to have diversity here, and all types of diversity at the Mortgage Calculator. So you do have to understand, though, the impact that your marketing is going to have on the type of business that you're going to be developing. Very important. At the Mortgage Calculator, we love, obviously, investors, right? We love non-QM, we love investors. So, that's our focus, but that is not all that we do. So first step, marketing. Second step in the process is the pre-approval. Right now, you land the lead, you land the borrower, or the prospect, let's call him at this point, right? He hasn't applied yet. He's a lead, he's a prospect. So it's critical at the pre-approval stage to have communication, right? Thorough communication of all the different facets of the loan that could affect the borrower. Remember, we are the licensee. The borrower is looking to us for guidance, and it's very important that you meet the mark. You would be, unfortunately, it happens too often, right? Three people look at the same deal, maybe not at the same time, but look at the same deal and offer three different options to the borrower, and then they may all be right to an extent, or two may be wrong, one may be right. But the important thing there, I think, would be in your communication to the borrower. Thoroughly empower the borrower with knowledge. I love educating my borrowers. I pre-educate them on the whole process. on the loan type that they're doing. After we review, we do the pre-approval, and we reach we make a decision on the best option for them. And then I'm not going to tell you I'm going to bring the guidelines out and just say, look at the guidelines, but we're going to discuss them point by point. I may have them on another screen while I'm on a Zoom with my borrower, on a call with my borrower, and I'm talking to the borrower, letting them know why we're doing this option, what could be the the potential pitfalls for this option. So we try to be proactive in the gathering of all documents that we're going to gather up front, right? All that stuff. I mean, you've heard me talk about the letters of explanation for my letter of explanation. You know, all thoroughness is so important. A valid pre-approval, right? The application is another stage of the process, and I'm going to go a little bit deeper into the details we were just discussing in the next slides. The application would be your next step. Right now, you've established the option, you've established with the borrower an action plan, and the borrower has applied. Remember, you got to have a valid option for the borrower, and that's up to you as the MLO. If you provide invalid options that the borrower loves, like sending somebody who's buying a 5-unit property conforming loan options, and then having them apply for a conforming loan full doc when it's really should have been a DSCR loan, even if it was a 1-unit and not a 5-unit. But those are the key things where you have to uncover all aspects of the deal. The borrower may not know what information they need to share with you. So you may, unless you ask, you may be communicating with the borrower for a week and assuming the wrong property type on this pre-approval, right? And you're off on a tangent. Customer loves your tangent, right? Super low rates, low cost, but it's not applicable. So that's what we don't want to do. So now, assuming you have a valid application, concerns at this stage of the game are compliance and disclosure, right? Compliance when you're setting up your file, like points and fees, right? This is critical because now this file is going to get disclosed, right? Once the customer applies, you're going to have a triggered file, needs to be, and if they're applying already with an address, that's a triggered file. Let's put it that way. And if it's a refi, definitely a triggered file. So you got to be aware of compliance with critical components like points and fees, right? Is the structure that you're attempting to set up a structure considering the customer's credit and other factors of the loan? Is that something that's going to be able to be in compliance of either the 3% rule plus bona fides or the 5% rule if it's non-trid, whatever may be applicable? There are different compliance considerations to um, look at about pricing and the loan structure and the loan to value and all of those things, right? Do not try to put a square peg through a round hole. Then you're going to disclose your file. File's going to go to processing. Then it's going to go to underwriting, right? Loan submittal, and then clear to close and closing. So let's touch base on a few more things here. Now, what are the types of mortgages, right? So I obviously like to put non-QM in the top. Most people would do agency in the top, but no. Look at how many more options we have with non-QM, right? And I had to limit it because I tried to keep it to one slide there, and there's already a lot of stuff on there. But full doc, right? I mean, full doc is not just agency. Full doc is just an income type, right? Full doc is full doc. So non-QM, right? We have our full doc loans. We have our bank statement loans for self-employed borrowers, profit and loss loans for self-employed borrowers, DSCR loans for investors, where we're only using the property's income to qualify the borrower. We have asset utilization loans, where we're using assets like checking, savings, mutual funds, stocks, bonds, all that kind of stuff to qualify the borrower as income. CDFI loans, which are no income verification loans with no job verification for primary, second homes only, up to 80% LTV on a purchase. We have 4 national borrower loans, and we have portfolio loans, which are a blanket loan that encumbers multiple individually folioed properties. That doesn't mean we're not. So when I'm talking about 8 units in a portfolio, I'm not talking about an 8 unit building. An 8 unit building is a multifamily structure with one folio number that has 8 separate living units. We're talking about 8 separate properties. Could be duplexes, whatever the program allows, but they're individually folioed properties. One of the benefits of the portfolio is to um, finance lower valued properties, right? We have portfolio options where we can have the loan amount as low as $50,000 per property and have like 2, 3 properties minimum in that portfolio. Now, LTV, the value would probably have to be somewhere around 75,000 or 80, whatever 75% is on a purchase or on a cash out refi. That would determine your minimum loan amount, 50, and then your value, probably 75, somewhere around there. So portfolio loans, really good option. And we love the portfolio loans because we bring what we put them into them when they buy all those cheap little properties, and then within a year or two, those properties have skyrocketed in value, and now that investor wants to cash them all out into individual DSCR loans because now they can do that. The properties have more value. We can go a higher loan amount and we can cash them all out, give them lower rates, put a lot more money into their pocket, and they can buy another portfolio of properties. It's a beautiful thing how that happens. Then we have agency loans. Agency meaning the GSEs, the government service agencies, Fannie and Freddie, and Ginnie Mae. Ginnie Mae is for the government-backed loans. They're the purchasers. So Fannie, Freddie purchase a conventional. Ginnie purchases USDA, VA, and FHA. Agency loans are always fixed rate or ARMs. Excuse me, they're always full doc, and they are either fixed rate or ARMs. ARMs aren't very popular right now, obviously, but they are an option. But agency loans always full doc. Bank statement is not an option there. FHA, right, 96.5% LTV plus DPA options. VA, 100% LTV for vets, active military only, and spouse of the deceased vet as well. VA allows for 100% cash out refi as well. We actually have an option for that. USDA, rural option, 100% financing, primary homes only, and conventional, which is, like I mentioned, Fannie and Freddie. Conventional offers first-time home buyer 97% LTV options as well. Very good options. Then you have jumbo loans, which are any loan above the conforming loan limit for the area where the property is located. So jumbo loan limit conforming loan limit just went up in a lot of areas. They're adjusting those. 750 something, I think, is going to be the minimum. So keep an eye out for whatever it is in your area. Anything above that is a jumbo. And you have prime jumbo that uses DU. So we've discussed prime jumbo. It's a full doc option that uses DU. So it's sort of agency, but not, right? Good pricing on that. Then we have commercial loans, right? True commercial loans, right? Like for buying professional offices or warehouses, storage, gas stations, whatever it may be, true commercial loans. And then we have our private investor / hard money equity based lending, right? So we got a lot of different mortgage types that we can participate in. Now, obviously, your actual participation in those is going to depend on licensing requirements for each state. So, you would review the resources that we have, and you would determine if, you need to be licensed or not in that state to originate it. If not, if you're not licensed and you need to be, you can refer it to intracompany referral and make money. Now, what is now? You got the application, but properly vetting that loan application, that borrower is going to be, very important. I'm not going to say the most important, but it's just as important as a proper pre-approval, right? Because this is part of the process. Now the customer has applied, right? But when they apply, we do our pre-approvals as a full application too, by the way. So this is applicable for a TBD pre-approval or for the pre-approval for that purchase where they're already under contract. Important to start off on the correct trajectory. I can't specify that enough. Know your resources. Reach out to your team leader. Reach out to your mentor. Reach out to the guidelines. Reach out to the knowledge center. Reach out to every resource you have out there, especially if you're new. Right? We don't get tired of you reaching out for assistance when you're trying to put deals together. Right? And it's all good. That's very positive. What is not positive is if you don't reach out and then you slip and now you're trying to clean up the mess and now everybody's working 5 times harder because you weren't proactive in reaching out. So we are there to assist. So determine the loan purpose and occupancy, right? So important. Question the deal. Question if it makes sense. Remember, as the loan originator, we have responsibilities for accuracy, controlling fraud, and just doing your job properly. Listen and determine proper purpose and occupancy of the home for the loan type. Like if they're an investor or if they're doing a primary or second home, don't offer them a DSCR if that is for investment property only. And I only say that because I've seen that happen. You're going to properly vet their credit and you're going to note certain items, right? It's not just about the credit scores, for example. Trade lines may matter as well. So you got to review the guidelines to see how credit comes into play for the particular option that you've chosen. If it's agency, you're going to have automated underwriting is going to make that decision in some ways for you. You're going to see if you're more or less in the framework, then you're going to submit to automated underwriting. But if it's non-QM, it's a different story, right? You definitely want to ask the borrower if they've recently checked their credit and what their scores are. Ask them where they checked their credit, or if not, suggest that they go to Credit Karma or the Experian app or one of the other apps that are free that they may already have or they can easily get and have them check their credit. You can do a soft pull also. That's another option before they actually apply to have an idea of where the credit is, because they may tell you it's a 740, then the credit pull comes back at a 600. So that's a lot of wasted time, effort, and credit report. If they're thinking 760 and now they come back and it's a bank statement loan, 90% LTV, you're thinking, yeah, I got a great option here, and all of a sudden it comes back and you can't do anything. So try to vet the credit as much as possible, right? Find out if they have other properties financed, because that's going to determine also if you meet certain check boxes of the loans that you're trying to qualify your borrower for. Like if you're doing a DSCR loan, pre-approving them for a DSCR loan, and the option that you're looking at doesn't accept first-time home buyers and doesn't accept first-time investors, you gotta then be asking, those additional questions about other properties financed and owned and investment properties and all that kind of good stuff. If there's already a property in the picture, either because it's a refi or it's a purchase, real important here. They seem pretty basic stuff here, but you'd be surprised how many times this poses an issue on a file that's already been disclosed when the appraisal goes to the property, right? Are there any property condition issues? Because I'll tell you what, by the way, if they're doing a DSCR loan, that property needs to have a kitchen. It needs to have bathrooms. It needs to have appliances you can get away with, but if the property is not being lived in, right? But like you're purchasing it. But if it's I had one where it's a DSCR loan and the property really needed a fixed flip loan. I don't know if they were hoping the appraiser wouldn't notice that the property didn't have kitchen cabinets and was missing bathrooms, right? They're like, well, we got to finish it. We were hoping we could get the money from the refi, FHA refi, to finish the home. No, that doesn't work that way. And this file got disclosed, and we didn't find out about this until the appraiser went out and says, "Hey, wait a minute." We get a note from the appraisal management company. Oh, appraiser wanted to know if you knew that the house didn't have a kitchen and it was missing both bathrooms. Oh no, we didn't know that. And MLO didn't know that, but the MLO didn't know that because the MLO had not inquired on that, or else the customer probably would have told them, unless the customer lied and was hoping that the appraiser wouldn't notice it, right? Who knows? But find out if, again, any property condition issues. Confirm that the use is conforming for the property. So, in other words, if it's a DSCR loan, as I keep going back to DSCR loans because these are valid situations that keep coming up. If it's a DSCR loan and the property is split up, it's a 3-bedroom, 2-bath house that they split up internally into a 2-1 and a 1-1 non-conforming, and they did it without permits, that's not an ADU within the home that has a conforming use. You could only do that on a 3-2 if it had if you did it with permits, right? If you legally did that renovation with permits, told the county, I'm going to break it up into a 2-1-1-1. It's going to be my ADU, right? Because now some municipalities like in Miami-Dade County, they allow that, and in the city of Miami they allow ADUs because we have a tight housing situation here, so they're allowing that. It's more acceptable. But understand now that the guidelines state, all of them are going to tell you that if you want to use income from that ADU in any way, or if it's set up like a 2-1-1-1 out of the same structure, it has to be done with permits. You could have a separate unpermitted detached ADU in some guidelines. That's a different situation. You'd have to review the guidelines and see if you could even use that income, or if they're just going to tell you, I'm going to have it there. But again, that all goes down to confirm the use is conforming. We had another one where appraiser went out to the house and it was something like that. They said the house was a 4-unit property and it was a house chopped up into 4 units. Appraiser's like, I can't do this. So all of those issues could be addressed up front. And then you definitely want to analyze the market value of the properties. A lot of ways you can do it. For example, you can reach out to your friendly neighborhood real estate professional who you've established a relationship with or trying to establish a relationship with, and tell him, hey, Mr. Friendly Neighborhood Realtor Specialist, I'm Jose Gonzalez from the Mortgage Calculator, and I got borrowers that I want to send you so that you can pre-approve borrowers for your market. Working with one right now. Matter of fact, I need to know a value here, by the way. Could you check this? And maybe they'll check it for you and give you a value, and you establish a relationship, because some areas don't share their information feed. You're going to find. You can go, or Zillow, or if you're a realtor like me, you can go to Realtor Property Resource and check, and then hope that they share the feed so you can get the data. If not, then I got to reach out to my realtor partners out there and ask them to do a comp, send me some comps, right? But analyze market value for the property, and please review the property public records. Don't go blindly into this. Disclose a file without having confirmed, for example, property seasoning, right? How long has the seller owned the property? Because that does come into play. How long has the borrower owned the property if it's a refi and it's cash out, right? So you're not going to know. And that's what you're going to look at, is the use conforming and all that kind of stuff. Review public records. Determine income type and employment type, right? Are they an employee, right? Hourly, salary? Is variable income coming into play? Tips, right? Bonus, overtime? Are they self-employed? How long have they been self-employed? Do they get a 1099? Do they have bank statements that could work if they're self-employed? P&L, do they have a tax preparer that does their tax returns that can help and assist with the P&L and or third-party verification letters if it's a bank statement or P&L loans? Because those are items that could come into play, right? And could, put a hard stop on your deal if it can't be resolved. If you get a bank statement loan that says, you need third-party verification of the self-employment status of your borrower, and the borrower self-files tax returns, and they don't have a business license or anything like that, and you're going to have there's going to be an issue there. You're going to have to do a lot of figuring out on how you're going to verify that borrower's self-employment to satisfy underwriting. Obviously, work well with the guidelines, work well with your AE there. Maybe they can give you some good nugget of knowledge there. And assets, right? Source and season, or determine if sourcing and seasoning is required for the option you're selecting. Today, I helped an MLO disclose a file, cash out refi. They came in thinking one investor was going to work for that file, but after we reviewed the file, we realized it's a rate and term, but the option he was considering has issues even on rate and terms if they have less than 12 months seasoning on title, right? It could affect the valuation, right? And then on top of that, this particular option he had chosen also is going to source and season the assets, the money, the reserves. So after reviewing all of that, and after seeing that the borrower has only been on title for 4 months, and the fact that we would love to try to get as high of a market value as possible, we reviewed guidelines, we switched the option to an option that had no seasoning on title and no seasoning on assets, because the borrower was going to get the money from a business credit card and deposit it into his LLC account for the reserves. That's only going to be acceptable if you have an option that doesn't source nor season any deposits going into the bank statements, right? So we do have options for that. And that's the one where he sent it. Wasn't much of a difference in pricing. And actually, he was pretty, you're welcome, Corey. and actually, Corey, now that he let the cat out of the bag, Corey was very excited that there was a no seasoning option there on title and on assets. So that opened up a whole additional side of the equation that could help, because this borrower is bringing money to the closing, right? This borrower property was purchased as a primary. Now it's transitioned to investment property. He's refinancing it because of that. And, he's bringing money to the table. So having a no seasoning program was very important in every which way. There you go. Yeah, Michael. So now you got your deal submitted, right? It's disclosed, should I say. Now you're finalizing, gathering to submit to underwriting, review by underwriting. Your file's just been assigned to a loan processor, right? Once this gets disclosed, it gets assigned to a loan processor, intake processor, grabs it, does the intake duties, registers it onto the portal of your choice, and assigns to a loan processor. Right then and there, you get the email. You should be reaching out to the processor and having a meeting of the minds with the loan processor on that file to ensure that everybody's on the same page, so that you can determine who does what, who's responsible for what, because not every MLO works the same with every processor, right? Some MLOs are more hands-on and want to order the appraisal right away, want to order title, want to order everything that they can up front, and then have the processor follow up on it. Other MLOs, want to let the processor handle more of that. So that's totally up to the MLO and the processor. The processor would prefer to order all the documents themselves, but you get it. You get the file before they access to the file before they do. You can order those things. Just make sure that you see who your processor is and you tag them on all those orders so they can assist you with following up on the items as a good processor will. They'll be more than happy to follow up with you on anything. You just have to communicate clearly with your processor, because the gripes that I hear every now and then from MLOs are MLOs that haven't communicated clearly with their processor in the beginning of the loan to establish this meeting of the minds, right? It's a two-way street here with the communication, really important. Communication, again, so important. Communicate the needed items in detail to the borrower early in the process. Review the guidelines. Review the guidelines to clarify any underwriting conditions. So once you do get the conditional loan approval, or if you're trying to be proactive in what you're going to receive as conditions, review the guidelines. You should be doing that throughout the whole process, the pre-approval, throughout the whole process. The guidelines are your Bible. Use your technology effectively. This includes your CRM. Remember, you should not be having borrowers email you documents for that you're requesting via submissions. All of that is requested via CRM. Your processor can assist you requesting the items via the CRM as well, because it comes from the MLO, not from the processor. Processor has access to your loan file in the CRM. They can assist you. Those are all things they know they're able to do. Just need a meeting of the minds, right? Uh, Submit conditions as complete as possible once you do get the conditional loan approval, not piecemeal. No underwriter loves to get 10 different sets of emails with 2 conditions when they sent you 20 conditions on the approval, and you send it to them in 10 different emails, 2 at a time. Man, oh man, once by the second or third time you do that, they're just gonna, if they see your conditions are not complete, they're just gonna set them aside and wait for you to send more conditions till they are at a point where they feel they can review the file. The only time you should really be sending something like that to an underwriter is when you need clarification on a specific make or break item, right? Something that may have to do with credit, something that may have to do with income, whatever it may be. That's when you would do like a single item for review by the underwriter. Like for example, a change request. You need a change request because the appraisal came in lower, and you're going to request that from the underwriter. Okay, you upload the appraisal, right? Or your processor uploads the appraisal, and the processor requests a change request if your loan's not locked in. Hey, look, uh, underwriter, the value came in at 375. Can you please adjust the value and adjust my loan to value and adjust the loan amount right down? They're going to do that, and then they're going to update the portal, and then you're going to be in sync with whatever is there. So make sure everything is submitted as complete as possible. And at the end, one thing to note with loan processing and mortgage loan originators is the loan is not a baton, right? You don't get the loan and hand it off to the loan processor as like you would as a baton in a relay race and forget about it, right? No, you stay involved in the process. The MLO is the one signing the loan application. The MLO is the one that's accountable for the loan, and the one that has to ensure that everybody's doing their job, right? It's not the processor's job to ensure you're doing your job. It's your job to ensure that everybody else is on point, and that the file is in trajectory to close. Now, so tips for a smooth loan process and closing. Now, doesn't that look like a happy mortgage loan originator, right? He's pointing you in the right direction. So here we're going to just recap everything important that we've discussed and how it pertains to success in this process, right? It starts at the inception, the germination, right? Start with an accurate and valid pre-approval. If you're off on the incorrect trajectory, sometimes you can never get back on. Like when the astronauts are going to the moon, if they miss that moon by a degree, they're going off into nothingness. They don't get the orbit, and they're lost. So again, you could be like that listless astronaut going into the blackness of space, no gravity to draw you into the moon, because your pre-approval was not accurate and was invalid for the loan type that was offered and applied for. Effective and open communication with the borrower and everybody else, obviously, with the investor, with the lender, with the underwriter, with the loan processor, with everybody. Don't get lost and expect everybody to do your job, especially if you want to have receive referrals from the borrower in the future, and have your loan processor happily process your file, and have the loan underwriter happily underwrite your files. They love when they get, oh wow, this is a file from John Smith, he's such a thorough MLO. Let me grab that one. And that one gets underwritten in 10 minutes and approved same day. And then the file from the troublemaker. Oh no, look at this file. It's a hot mess. It takes them 3 days to review that file because they got to build up the courage to open it. So that's, maybe a little bit, exaggerating there, but you get the picture, right? Be proactive with your documentation. We talked about reviewing guidelines. We talked about, trying to see foretell what obstacles you may be facing. You're not going to know that, be facing. You're not going to know that unless you review the guidelines, right? Unless you're proactive up front. When you got that loan application and you're going to need a letter of explanation for items A, B, C, well, submit them with the loan application. If you have a weird scenario with your loan that needs some type of a underwriting narrative letter to go with the file to the underwriter so they know exactly what you're doing. Don't leave it up to them to figure out what the loan is about, because that could result in a suspended file and a list of like 30 or 40 conditions that may not be applicable if you explain what's actually going on. So notice it's going back to communication, right? Address issues promptly, right? Loan conditions, um, preconditions, anything that you see is going to be an issue with the loan, like your foreign national loan. That foreign national borrower is going to have an issue possibly in closing the loan, because that loan is going to have notarized documents, and those documents need to be notarized either in person here in the United States or at a U.S. consulate or embassy outside the U.S., or by a couple other options that may be available, like remote online notarization. And then there's another one that I can't remember, that we use for a commercial deal, which is another type of remote online notarization. But all of that needs to be set up early in the process, not 3, 4, 5 days before you close. Because if the only option ends up being they got to go to an embassy or a consulate, and the next appointment is in 2 months, and your loan lock expires in 8 days, wow, that's that. If you would have told the customer that in the beginning, they could have made that appointment. Maybe they would have done a little bit long, to give themselves an extra time. Fine, you understand, pay for a little rate lock extension. They understand that cost has been discussed as part of the game and the foreign national game, but all of those are expectations that you set by properly explaining the process to the borrower and addressing certain issues, including that issue, promptly. Ensure accuracy of all docs, especially the initial 3-day closing disclosure that goes out, and that the mortgage loan originator is one of the essential parties that has to review it for their part of the transaction, right? You helped create the loan. You got to make sure that it closes in an accurate fashion. So when they send that CD out for review to everybody involved, including the MLO, review it. Look at the taxes. Are they accurate? Do they match the tax certificate in the file, right? Look at the PITI. Does it match the approval, the clear to close approval? Look at the assets, the cash to close. Does it match the clear to close approval? So, a lot of things that the MLO has to do when they're reviewing that 3-day CD to ensure that the loan is going to close quickly and accurately. You don't know how frustrating it is when the MLO is blowing up the closing department's email. I need to close that yesterday. I need to close that yesterday. And the file is nowhere near to close. The CD doesn't match the clear to close. We have there's a name wrong here. There's something wrong there. The insurance is we got things that are off that are going to take a day or two to resolve, and they're blowing us up to close when they're not ready yet to close, right? So help us help you, right? And now these last two bullet points are essential to sustainability of your career, the happy closing, referrals, right? Higher profit margin on your marketing is take time to explain the final terms of the mortgage to the borrower and confirm that everything is what they expected, right? Don't have that happen at the closing table. Don't have a borrower threaten not to close or threaten not to sign a post-closing document and now potentially be in default of the contract because you did not accurately explain to them how the deal is going to close. It may have changed. They signed LEs along the way, but they don't remember those things. They're going to look at the closing disclosure though real closely. They're going to remember that one. So you explaining along the way and then confirming the final terms is important. And then last but not least, attend the closing in person whenever possible, right? I mean, obviously, I'm not going to go to a closing in Ohio or in Washington State, but I'm certainly going to go to my local closings, and some of us do get local deals. So, whenever possible, schedule your day and attend the closing. The people love it, and they will immediately try to send you business. So, a lot of tips here, a lot of back to basics, but a lot of good information here that are going to help many of our MLOs within the team and those out there that are listening to this presentation.
All right, great. I don't see any questions, but that was awesome. Definitely hope some people go back and watch this. If you're a newer loan officer, I would definitely watch this again.
Oh man, I would tell you these points I'm stating here. I didn't have to do too much research to come up with a lot of these items. This is battlefield. This is hot off the battlefield advice, right? So definitely a lot of this, if you're brand new to the business, if you just stick to a lot of the stuff that we discuss here tonight, you're guaranteed not to fail. You're guaranteed to succeed. That end, obviously, I didn't touch base here on knowledge, right? Continuing education, always increasing your knowledge base. I've been 28 years in the business, and I learn new things every day.
All right, great. Well, thank you everybody for tuning in. We will be back next week, 7 p.m. Eastern on Tuesday and Wednesday for the next episodes of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thank you, everybody. Have a great night.